If you own technology stocks or traditional manufacturing companies, today the market gave us a very confusing puzzle. Inflation went down, but the fear of the future actually went up. Today, the January Consumer Price Index slowed to 2.4%. Then we follow how the fear of massive artificial intelligence spending suddenly spread beyond big tech, dragging down software and financial stocks this week. Then we look at the pure chaos in the industrial sector, where reports of a steel tariff rollback crushed metal stocks, even though the White House quickly denied it. Stay with me, and I will translate this noise into simple cash flow, so you know exactly what is happening to your money. Let us start with the inflation data and the Federal Reserve. Today we learned that January headline inflation slowed down to 2.4%. This was mostly because gasoline and energy prices dropped significantly. The bond market loved this news. The 2-year Treasury yield, which tracks borrowing costs, dropped to 3.4%. But Chicago Fed President Austin Goolsbee stepped in to calm everyone down. He said the recent strong jobs report is a good sign of economic stability. However, he warned that inflation in the services sector is still too high, and the Fed needs to see more progress before they cut interest rates again. The common misunderstanding here is that a lower headline inflation number means everything is getting cheaper, and the central bank will immediately cut rates to zero. Think of the economy like a house with a broken thermostat. The living room is freezing because the air conditioning is blasting, which represents falling gas prices. But the kitchen oven is stuck on high heat, which represents sticky service costs like medical care and housing. The overall temperature of the house might look lower on average, but the kitchen is still dangerously hot. Let us trace this into how companies actually make money. Lower bond yields usually mean companies can borrow money at cheaper rates. This is great for their balance sheets. But if everyday consumers are still struggling to pay high prices for rent and hospital bills, they are not going to buy extra clothes or new cars. So even if a company saves a little money on interest payments, their total sales revenue might stay completely flat. For free cash flow, this creates a trap. Companies cannot raise their product prices anymore because consumers simply will not accept it. But their internal costs, like employee wages, are not dropping. This pinches their profit margins. The cash they manage to save from cheaper debt gets entirely eaten up by their shrinking sales margins. Your one-line checkpoint for this segment. Borrowing money is getting slightly cheaper, but companies are losing their power to raise prices on exhausted consumers. This brings us to the massive fear that gripped the stock market this week. The panic over artificial intelligence spending is no longer just an Amazon or Microsoft problem. The fear that artificial intelligence will reshape entire industries caused a massive sector-wide sell-off. Over the past few days, software companies took a huge hit, with Workday dropping 11%. The panic even spread to the financial sector, dragging Charles Schwab down almost 11% and Morgan Stanley down nearly 5% for the week. At the same time, the government is reportedly stepping up its antitrust investigation into Microsoft's cloud and artificial intelligence business. The misunderstanding is that dropping stock prices mean artificial intelligence is a complete scam or a failing technology. Imagine a massive construction project building a revolutionary new high-speed railway. The builders are spending billions of dollars every single day on steel, concrete, and workers. But investors driving by only see money leaving the bank account. They panic because they do not see any passenger tickets being sold yet, completely forgetting that the trains cannot run until the tracks are finished. We can follow this straight into the earnings path. Major tech companies are pouring hundreds of billions of dollars into data centers and servers. This equipment goes on the balance sheet and slowly loses its accounting value over time. That depreciation acts like a heavy weight on the company's operating profits. But the fear has now mutated. Investors are not just worried about the cost of building the technology. They are terrified that this new technology will completely destroy the business models of traditional software and financial service companies. Now look at how this changes free cash flow. Wall Street is demanding to see actual cash returns right now, not just promises of future growth. If a company is burning cash to build servers, they have less money to buy back their own stock or pay dividends to shareholders. The market is violently punishing any company that cannot prove their massive investments will turn into positive cash flow in the near future. Your one-line checkpoint here. The market has stopped dreaming about the magic of artificial intelligence and is now aggressively demanding to see the hard cash receipts. Now we pivot to the industrial sector, which experienced absolute chaos today over trade policy. Major news reports indicated that the current administration was considering rolling back the heavy 50% tariffs on imported steel and aluminum to help lower prices for consumers. Industrial stocks crashed immediately. Cleveland-Cliffs dropped over 13%, and Nucor fell nearly 3%. But right before midnight, White House trade advisor Peter Navarro completely denied the report, calling the reports groundless. The misunderstanding is that tariff headlines are just political drama that only matters to politicians in Washington. A tariff is exactly like a tall, sturdy wall protecting your private farm. If sudden news breaks that the mayor might tear down your wall tomorrow, you panic because cheap crops from the neighboring town will flood your market. Even if the mayor later comes out and says the wall is staying, the sheer panic already made you cancel your plans to buy a new tractor. This moves straight into the earnings path for American manufacturers. When a steel company thinks foreign metals might suddenly flood the market, they assume they will have to slash their selling prices to compete. Because their costs for labor and raw materials are fixed, lower selling prices mean their profit margins get crushed instantly. Even though the White House officially denied the report, the damage to investor confidence is already done. When we translate this to free cash flow, the impact of uncertainty is toxic. Heavy industrial companies require massive multi-year investments to upgrade their factories. If executives cannot trust that the government will protect their market, they will freeze their spending. They will hoard their cash instead of upgrading their equipment. Wall Street hates this kind of policy whiplash because it makes future cash flows impossible to predict accurately. Your one-line checkpoint. Abrupt policy reports act as an immediate tax on investor confidence, forcing companies to hoard cash rather than invest in growth. Let us look at the energy layer connecting all of this together. Oil prices have been falling for 2 consecutive weeks, with crude oil dropping to around $62 a barrel. The main reason is that geopolitical risks between the United States and Iran are easing. However, the administration is reportedly sending another aircraft carrier to the region just to be prepared in case negotiations fail. The misunderstanding is that lower oil prices are a sign that the global economy is heading into a deep, dark recession. Think of oil prices like a mandatory delivery fee on everything you buy. When that delivery fee goes down, ordinary people have more money left in their wallets at the end of the month, and delivery companies spend less money on gas for their trucks. The earnings path here splits in two. For airlines, shipping companies, and everyday consumers, $62 oil is fantastic news. Their daily operating costs drop, which expands their profit margins. But for the energy companies actually pulling the oil out of the ground, their total revenue is shrinking. This directly changes how energy executives manage free cash flow. Because oil is cheap, these companies are not going to waste money drilling new wells. They are cutting their spending down to the bare minimum. By spending less, they protect the cash they already have. They use that saved cash to pay down their debts and buy back their stock, choosing financial safety over risky expansion. Your one-line checkpoint. Cheap oil acts as a massive tax cut for the everyday economy, while energy producers shut down growth to protect their cash vaults. To bring it all together for your portfolio risk today, the headline inflation number looks better, but underneath the surface, things are highly unstable. The market is terrified of how much money is being spent on artificial intelligence, and that fear is dragging down entirely different sectors like software and banking. On top of that, chaotic policy reports about trade tariffs are making it impossible for industrial companies to plan for the future. With the United States stock market closed this coming Monday for President's Day, use the long weekend to recalibrate. When trading resumes on Tuesday, watch the 2-year Treasury yield closely. If it stays low around 3.4%, it means the bond market is not just celebrating lower inflation, it is actually building a bunker to hide from a slowing economy. This analysis is for informational purposes only and does not constitute investment advice. If you found this breakdown of the macro to micro earnings path helpful, please subscribe and leave a comment below.